You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
If you put them in that cone of silence for 6 months and didn't let them out, and they had to watch what happened to their firm, there wouldn't be much left to come back to in many cases, because they've, in many cases, got amazing teams, but it's sort of an upside-down pyramid where it's all built and hinges on you as the leader of your respective organizations. So to the extent we can flip that over and try to build the systems, the processes, like Matt mentioned in his presentation, the workflows, trying to standardize that process, that model, will make your firm so much more valuable, whether it's to an internal successor or a peer consolidator. So with that, I'm going to wrap things up. Were there any questions I didn't get to? Okay, please. Good question. So the average was they were financing about 75% of the deal, and then the seller would carry the other 20, 25. You bring nothing to the table, which is why I think a lot of buyers who are trying to acquire more and more practices are leveraging bank financing, because it doesn't tie up any of your personal collateral. But I would say the norm so far this year, because we're all the way through Q1, most of the buyers who are qualifying for the bank financing, which is basically all of you, as long as you have an existing book of business, you're likely to qualify. The bank will loan you 100%. You may not want to use it in every case, but it's available. Yeah. 10-year term, the payback is sometimes either 10 years or you can get a 7 and 10 with a little bit better rate. And the rate generally is in the 6.5 to 7.5. Yeah. Question? Yeah, the question is what percentage is SBA financed? How many of you ever been through an SBA loan process? Would you speak in affectionate tones about it? You take the good with the bad. The SBA lenders will very quickly get to financing 100% of the deal, but you're going to have 500 pages of forms to fill out. So the short answer is, I would say of those, you're probably looking at about 60 to 70% are SBA financed. But the SBA financing is trending down, not in terms of lack of availability, but now there's more conventional lender solutions available. Does that answer your question? Okay.
Any other questions?
Awesome. All right. Jamie? Thanks.
Thank you, David. I'm going to invite our panelists to come up now. And in doing so, this morning we heard from Matt Fronsky at SS&C, gave us a baseline of where the industry's going, what you need to do in terms of structure and some ideas, and applying technology and AI to leverage and grow your businesses and your profitability, and most importantly, your valuations. And David just talked about and shared ideas on how to maximize the value of that practice. Now we've got the opportunity to have three very successful operators here with us to talk about what they've been able to do over the years in building their firms and maximizing values, and hopefully you'll be able to take, there's some key tenets that you'll be able to take back to your business, and of course you can lean on any of our speakers for more information. And just as I know there's a lot of pictures being taken of some of these screens, there's a lot of good data up here. We're going to provide all the screens for you at the end. So we'll put that out in electronic form, but you're welcome to take pictures. So with that, David.
Awesome. So we've got with us here three really amazing panelists to talk about creating and maintaining sustainable businesses. So to kick things off here, I was going to try to give you a little bit of background on each of them, but each of your businesses is so unique, and I would tell you wildly successful, that I couldn't possibly do them justice. So Andy, David, Matt, we'll just go in order and let each of you say a little bit about your firm, if you wouldn't mind. Kick things off, Andy.
Okay, so full disclosure, I used to be a wholesaler, and I I called that the dark side of the business. Now I'm on the good side of the desk. No offense, wholesalers. But so I saw a huge trend in the industry as I was visiting a lot of advisors, is that they were either by themselves, they were very successful, and they had no continuity plan. And they would ask me, hey, do you know any younger advisors that are looking to get in the business? We really need them either for growth or for continuity. So I saw that as my opportunity to jump in to the industry. After 6 months, I acquired my first $22 million practice, and that was in 2013. As of yesterday's close of business, I'm at just right around $330 million from simply acquiring books of business. And I think one of the most attractive parts of our business is that we serve different areas other than financial planning. It is the tax business. We have a business valuation service, and I am a certified exit planner as well. So through the BEI, Business Enterprise Institute, that has really allowed me to become a consultant to people that are looking to sell. So if, and pairing up with companies like SRG, that I can talk the talk and provide a little bit more education, be like, well, why are you going to sell your business this way? If you come with our firm, we can structure it this way. So that's really helped me to establish where I am now. And I'm based in Montgomeryville, Pennsylvania. It's a suburb of Philadelphia.
Awesome. Thanks, Danny. Matt?
Sure. Matt Cooper. The firm is Beacon Point. We founded the firm in 2002 in Newport Beach, California is where we're headquartered. Today we have right around $10 billion in AUM. 6.5 of that is private wealth management. The balance is either institutional consulting assets, endowments and foundations, or 401k advisory work. We have 14 offices, 12 of which have come to us through M&A. For the first 9 years of our existence, we were just like any other RIA, one client at a time, building the business. In 2011 is when we started the M&A endeavor, if you will. Our latest deal closed just last month. It was a little over $400 million just outside of New York City. So we have offices in Boston, Philly, the New York area, Dallas, Scottsdale, and throughout California. What else can I tell you? I'll tell you this, we're just getting started, so it's early in the game.
Nice.
My name's Dave Shepard. I started my firm 20 years ago in a basement. We grew that organically, one client at a time, to about $10.5 billion, 2 practice areas, an institutional practice area, ultra high net worth. 3 years ago, we looked at one of the verticals of our business, which is in the institutional side, and decided that was going to be a very bad business. This is namely the 401k business, for which we had been a leader in the industry. And so we began to think about how to pivot the firm. And so for a lot of you that are sort of under all kinds of pressures, we had grown one of the fastest growing sort of non-acquisition RIAs in the country. We took our assets down from $10.5 billion to $6 billion. We'll be back to in excess of $10 billion by the end of this year. And we did a radical departure in the firm, acquired a structuring company, which is a firm that specializes in structuring deals in the private space, real estate, venture. And then we tried to figure out how we were going to reconcile an unconflicted independent investment advisor with a structuring arm, and what that could mean to the company. So as we get into this conversation, we'll talk a little bit about it. It's been an amazing journey. It's been an amazing journey to grow for 17 and a half years, take a huge step back from something you cherished and loved, retool, and then rebuild a completely new capability, which renders the core business essential, but economically not nearly as profitable as this diversified business model.
Excellent. So our panel here and panelists are here to talk today specifically about building a sustainable business. And again, it segues, I think, from the last 2 presentations So I'm going to start out for each of the three of you just asking a simple, broad question to make sure we're all operating on the same page, and that is, what does building a sustainable business really mean to each of you? And in your case, Andy, small business owner clients, for your clients.
Well, because we're all in this business, I think anyone can be a financial advisor to a W-2 employee. That's one of our easiest tasks in this business. But you have to turn up your skill level to a niche area, and I chose small business owners because what I saw just visiting financial advisors, it actually startled me even more that most financial advisors, you talk to them about continuity and they're like, I haven't even thought about it. It's like, really? You're in the finance planning business and you haven't thought about financial planning for yourself? That's kind of odd. But so I figured if the financial advisor business isn't doing it, people in the construction services business certainly aren't doing it. So the niche is the initial industry you're in, and then you even niche it more, you niche it more, you niche it more, and then the association, joining the associations, becoming a knowledge. I've become addicted to consuming knowledge as to how somebody can exit their business in the most efficient way from a tax perspective, and then what to do with the money after they sell it. So I think as long as if you have that systematization or McDonaldization of your business that is geared towards serving the burger the fastest, most efficient way, repeatable process, that's sustainability in my opinion. That's where we are.
You know, when I think about it, I think about the reason why you exited the institutional space. The business is so commoditized now, and it's going to get much worse, right? So it's really, if you want to be sustainable, you've got to move away from all of the areas that can be commoditized and move towards the areas that cannot be commoditized. And that's primarily the human relationship. So the value in the business is all about the quality of your relationships, the depth of those relationships, and getting more of those relationships. So, and I got in trouble for doing this one time on a panel at another investment manager that was sponsoring it, but investments are literally the most commoditized part of the business. So trying to stake your claim on differentiating around investments is almost impossible. And it's getting more and more impossible by the day, by the minute. So if you want to build a sustainable business, you've got to move away from the old habits of the business, which are effectively going out and looking for math and science people to come into the business and do, financial planning and investment planning, asset allocation, that kind of stuff. And look for the liberal arts students, look for the people who are geniuses in the emotional quotient space, the EQ space, that are geniuses in terms of evolving the relationship with the client, and focus there if you want to be sustainable.
So I echo that. When we looked at retooling the firm, on the investment side, we came to the same conclusion. So as recently as 10 years ago, we had, 8,000 publicly traded companies? Today, we're down to less than 4,000 publicly traded companies. We have massive efficiency from a technological standpoint, an asset trading standpoint, difficulty for active management to add value, and it's because of the near perfect information in publicly traded markets. It's a radically different situation in the private markets. And the private markets is an area where the individual investor has really not gotten access, the institutional investor has, at the highest levels. And generally speaking, in those markets, nobody wants a blind pool. I've got a venture capital fund. That's great, Dave. God bless you, right? But most everybody, particularly if you have a sophisticated clientele, is interested in a transaction or a deal, particularly if they can get into the data room. Okay, they can talk to the entrepreneurs. It's the same situation in real estate. So while I agree entirely about the ubiquitous nature of the investment landscape, in the private space, we will have for the next decade increasing information, increasing access, but it's still a very rarefied location. The economics that can be generated in that space, both for the client and for a parent firm, are radically different than anything that we experience. So our goal in the pivot was, if you've got a vertical coming out of your firm, and we're all under different pressures, we all have diversified practices, and at some point, you got to look at your practice and say, what am I going to hold on to? Right? The relationship is the most important thing, but certain parts are good business, certain parts are not. What can you do that creates a self-reinforcing loop into the firm? will drive the remaining elements that are critical to the company and create a profitability engine that's unrecognizable to anything else that you're doing. For our firm, right or wrong, the decision was to move into the private space. So here's the asset that we all have that most of us don't appreciate. I acquired an asset structuring firm, which is a kind of funny thing. It's a bunch of attorneys, right? Former head of the SEC of Boston, et cetera. It's how do you structure an investment? First thing that happened is my best client, who's a billionaire in San Diego, came and said, Dave, we need help structuring a real estate project. And I said, that's great. What can we do to help? We laid out and wrapped our arms around a project which is right now the largest oceanfront real estate development project in California history. We're able to structure that on the debt side, on the equity side, and the profitability of that one transaction is greater than the gross revenue of my firm for the last decade. And I had one of the largest RAs in the country. That allows you to start thinking about staffing and investing in the company in a very different way. I brought it across town to one of the largest REITs in the world, and they looked at it and said, we're trying to structure Four Seasons transactions, and we're partners with the owners of the Four Seasons. Can you help us do that? Because we don't have a good way to structure the capital. We said, well, we know a lot of RIAs. They have a lot of capital. We have a lot of capital. My God, you can't believe how greedy the banking and the financing industry is. So you can go in, right, do business that is amazing relative to what we can normally charge and honor the developer, the financier. And so now we have exclusivity on a whole series of Four Seasons projects in the country. So, and I guess I'll close this thought by talking about a transaction we just completed, and this is what I mean by a circle. We just financed an investment banking firm. How many of you in the audience have a close relationship with a local investment banking firm? Raise your hands if you do. I highly recommend it. Here's why. They create clients. This institution, national footprint, does 15 to 25 transactions a year, each one between 100 to 300 million. That's 15 to 25 entrepreneurs a year created between 100 and $300 million in assets. They love their investment banking firm. These folks groom those professionals, accelerate their businesses, and exit them. They have 200 such clients over the last 5 years, representing $5 billion in assets. And if you want a warm lead into a client, get close with an investment banking firm. We took a slightly different approach. We bought a third of the investment banking firm, and we put it in a fund structure. The free cash flow yield in that company is north of 20% a year. Free cash flow starting on day one. Our clients went nuts. Wow, what a great investment. We got to meet a bunch of families we otherwise wouldn't get to. That core business is growing at 40% a year. The owner wanted to sell because he's investing inside of his deal flow. And he's making 5 to 10 times multiples because he's got 25 companies. He says, I've seen that transaction 8 times. They need this, 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 and this, and little capital. It'll be a tremendous exit. I can take that 5 years and pull it into 3 years. But he's been putting in 300 to 500,000 in these transactions. We said, how would you like a merchant banking arm? So we'll sell 35% of your firm for $35 million. Now you have $35 million to make investments. And we'll structure a fund with 100 to 200 million in it. We'll go back to your pre-existing clients, who, by the way, love you, and say, do you want to invest alongside Bob? Oh, Dave, let me tell you about my experience. Okay, listen for 20 minutes because I've heard it over and over. I give them 10% of my portfolio. We don't need 10%. We need 1% of your portfolio. So there's an opportunity, guys, to think about your practices in radically different ways that end up self-reinforcing. More lucrative, creating fascinating investments for your clients, and creating prospect flow. And that's the journey we took for the last 3 years, and that's sort of how we visualize growth. Because to my colleague's point, the conventional market's very, very difficult to differentiate, and they don't necessarily drive business inherently into the firm. And by the way, every one of you that has a significant investment advisory firm has 1 or 2 deals going on inside your firm every year. You don't know it because you're not looking for it. So whether it's a real estate transaction because you have a great client who's a developer, he's starved for capital, or whether it's some other transaction. And within this community of RIAs, there is, and there will evolve in time, a capability for you guys to build networks, find other firms that are doing structuring work. You can always talk to us and say, you know, I think we have an amazing transaction, but I don't know how to structure it. I would love to own a piece of the GP because it's going to be more profitable than most of what I'm doing, and I don't have a distribution network to go out and raise that capital. That's all there, and it's all inherent in your practices, and it's wildly lucrative. I share that with you as sort of an idea about sort of how sideways you can get with what you've built. What you've got is precious, and it's precious because what you have access to and what you can structure within a conventional firm.
Excellent. Thank you. So, follow-up question for you specifically, Matt, before I get to the next one, and that is, hopefully it's a simple one for you. With your advisors, why is sustainability such an important topic? I feel like it doesn't get talked about enough in the industry. So from your perspective, your advisors...
You're talking about the advisors that choose to join us?
Yeah.
But, you know, I think, you know, the business itself is basically the cash flows from our clients that our clients are paying. And so when you step back and look at it, it's kind of like a rat going through a snake. Eventually it comes out the other end and it's over, right? So they're most concerned with a couple of things. One is it's not fee compression, but it's service expansion. So it's the clients want more for the same fee or less. And so how do they deliver that? And then it's, oh my gosh, I'm so busy running my business today with all the clients that I have. How am I going to add new clients at the younger end of the spectrum so that way the rat doesn't fall out at the end of the snake eventually and it's game over? So it's really about, can I join a larger firm, have the resources and scale of a much larger firm, free myself up from all the non-value creating stuff that's essential. You have to have it. Somebody has to do billing, somebody has to do compliance, somebody has to look at the investments, somebody has to run the financial planning platform, somebody has to run the website and the social media. All that stuff has to happen, but it's really supporting what's actually creating value. So it's more about can they get to spend more time with their clients and finding more of them so they can refresh the younger end of the client demographic and have the business really be sustainable. The thing is that most of the RIAs, and I'm not going to pontificate here for the next 30 minutes, but 30 seconds, most RIAs, we got into this business because we wanted to create a career and a job that we couldn't get fired from. And we woke up a few years later and we're like, oh my God, I actually have a business. You know, some of us call it a practice, others call it a business. And then we have to make a fundamental decision. Are we going to create an enterprise value with a lasting legacy that has real equity value to it? Or are we going to have a lifestyle business that we're just trying to keep alive as long as we're alive? And both are great decisions. There's only one thing that needs to be taken care of, and that's two things, the fiduciary promise to our clients and the moral obligation to our teams. If we clean those two up, either one of those decisions are perfectly fine. They're good decisions.
Okay. So under the auspice of the conversation being sustainable firms for the next generation, each of you take a second and share, if you wouldn't mind, what do you think the single greatest threat, or maybe in a more positive way, opportunity facing advisors in the coming years is?
Want me to
Kick things
start?
off, Andy?
Well, you talked about it, and your presentation is one of them, is that we're having trouble finding people. I think that the systematization of the business, of course, handles that with a lot of this technology. But I would say really the biggest threat is that I see too many advisors relying, getting the shiny object syndrome by every single piece of technology that's out there. Don't get me wrong, there's tons of technology that makes my life easier, but the old grassroots style, it may be the wholesaler in me, I still love, just calling people directly and having the face-to-face interaction. And that's how I think I've gotten the most organic, referrals is that way. So don't go away from that. Still utilize the technology as to like what's available, but don't lose the grassroots hustle. I feel like that's what gives you the highest level of pride of entrepreneurship if you're good at it and you enjoy doing that, which I love.
So I don't know if we really know what the biggest threat to the industry is. I mean, there's something lurking outside the wall that we don't even know about. I mean, certainly Amazon's entry into the space would be a problem, but I think they'll probably create a B2B platform that we can all leverage. But I think if I step back and look at it right now, I think the fact of the matter is that most firms aren't really growing, and you hit on this. or maybe you hit on it, Matt. But the issue is when you look at growth, and I'm in a large study group called the Alliance for RIAs, allianceforrias.com if you want to look it up. It's me, Ron Carson, Brent Berdesky from Swan, and 4 other guys. But firms under $5 billion really aren't growing in general, on average, net of market. And so when this thing slows down or turns around, the tide's going to go out and you're going to find out who doesn't have a bathing suit on. So I think the fact of the matter is it's 10 years after the financial crisis. We're all 10 years older unless somebody's got a secret I don't know about. But when this thing turns around again, and if you're not positioned correctly in your portfolios, we're going to find out the sustainability of a lot of firms really quick.
I think the biggest challenge is profitability and the level of investment necessary to perfect your business, grow your business, hire the right people, keep them together. It's profitability. And it's the diversification of that profitability. And a lot of us have for a long time run a firm that's a one-trick pony. And a one-trick pony is a very tricky pony. Having 2 major practice groups, institutional and private, we used to command so much bill rate in the institutional side. I had other great entrepreneurs say, why in the world would you do private work? And we would say, well, who knows? This could be legislated away. You could have the plaintiff's bar come in. All kinds of things could happen. So I think the critical thing is finding diversification. You can find it through acquisition and build a larger and larger institution, or you can find it through other modes. But I think it's diversification and increased profitability. And that ultimately solves everything.
I had another thought on that, just really quick. If you think about it, the entire future of the business, each one of our businesses, is having the very best people supported by the very best technology, okay? So if you're not growing at 15 to 20% a year, you can't invest in those things. And so if you think about when you're out there trying to hire people, it's such a tight marketplace now. The best people want a career path. They don't want a job. And so if your firm isn't legitimately growing, and I mean by adding new clients, not just by market growth, if you're not legitimately growing by 15 to 20%, you are going to hit a wall at some point, and you're going to be faced with a decision about whether or not to just hang it up, sell, or to join a larger platform or merge with a larger firm. That's just inevitable.
And has anybody heard of the book Simple Numbers by Greg Crabtree? I'd never heard of it. It's not like a mainstream thing. How about Vern Harnish, the Rockefeller Habits? Okay. So in Simple Numbers, it's actually a humbling book to read as a financial guy. It shows you how to look at your business as a business and make sure that you are tracking things like that, stripping out market returns, looking at what your role in the business. If you had to replace yourself, how much would it cost? That's how much you have to account for, as that's your compensation. That's not profit. So to look at your business in that manner, that book really helps to compare apples to apples over 2018 versus 2019, and really keep you on track to make sure that you are hitting that 15% minimum real number. Because if not, I think you're dying.
Yeah, they're great points.
Simple Numbers, Greg Crabtree. And Rockefeller Habits, Vern Harnish is another one.
Excellent. Thanks, Andy. I know everyone appreciates some good additional reading material.
Mm-hmm.
So what are each of you doing to ensure that your firms can remain relevant to clients or advisors, for those of you that have both models, over the next decade? I'm going to kick things off, maybe, David, for your firm.
Well, again, we were looking for a vertical that was radically more profitable, that would drive business in. So we have a pipeline right now in private more robust than we've ever had, but they were all met looking at deal flow. Whether it was, and we looked at things thematically, so we do cybersecurity, healthcare platform in the VC space, et cetera. So these are large families that look at deal flow at a direct level and would never open themselves up to come in if you just wanted to talk about family office services or something like that. But boy, oh boy, will they open the door if there's an interesting cybersecurity transaction they can look at with a good leadership team. And once you're there, suddenly they say, what else do you do? And you say, oh, okay, and off you go. So for us, it's trying to find a complementary, self-reinforcing loop in the business model that will drive additional revenue and drive new investment opportunities. And I think and then you also have got to look into your business and saying, what is the best part of my business? What's the least sustainable part of my business? And the hardest thing I ever did, so we did early pioneering work in the 401k business. I loved that business, loved it. And 3 to 4 years ago, we took a look at it and we said, this is not going to be a great business in a decade. And so it's sort of military management. What's the 20% weakest part of your business model, right? And you get rid of it, and then you replace it with a top 20% functional area, and then you get into logarithmic growth. And I think that's it. It's destruction of certain elements, and you've got to drive to things that will self-reinforce.
You got a question over there?
Sure.
Hi, question for David. I'm assuming you're a pure RIA, that
Yes.
you have no broker-dealer
Yes.
compliance issues, and many of us have the hybrid RIA broker-dealer situation. Is that something you would jettison in your?
It's a great question. So the first thing I had to reconcile was we had always had an independent and unconflicted relationship with our clients, all right? Suddenly I'm doing direct deal flow in venture and real estate. Okay, how in the world do I do that? So like everything else in life, ask your clients. So I went to the 12 wise men that are my clients and said, hey, I'm about to do this. How in the world do I do this and honor this relationship was central to what we do? And they all came back and said, take 20 to 30% of every deal you're doing, carve it into a sleeve that's completely feeless, absolutely feeless, so that we can invest right alongside you, shoulder to shoulder. You lose 20 to 30% of the economic viability of the rest of the transaction. But we're talking about 2 and 20 on the deal flow side, or 1.5 and 20. Right? And we all live in the 40 to 120 basis point world in wealth management. At best, 120. I mean, I've lived in the 40 to 80 basis points. So that was the first thing we did. We had to align the new business model with the old. Now, suddenly my clients are saying, oh my God, we can't believe we're getting access to this type of thing. I mean, the Four Seasons transaction, guys, is a real estate transaction. 5 of the wealthiest men in the world, Bill Gates, Prince Talal of Saudi Arabia, King Abdullah of Bahrain, 2 others, and our equities side by side. De-risks in 3 years, 30 to 50% back at that point. And then we have 20% yields forever because of the structure of it. And they've done this 136 times, and it's owned by. So the clients are suddenly saying, my God, I get access to this. So that helped defend the bill rate because, right, we've got to try to command our 60 basis points and keep it on a big family. So what are you doing for me? Well, I'm going to give you access to this. The other 2/3 allowed us to go out to the market and introduce ourselves to a group of people we would never have otherwise gotten to, and add a profit engine, which then comes back into the personnel and sort of reinforces. We are creating a broker-dealer. So I've never had a broker-dealer. But there are provisions and exemptions if you structure everything in a fund. As an example, we looked at typical direct deal transactions, and that's all governed, guys, by transaction law, which is pretty weak law to protect your interest if you're an investor. So we created a fund structure, which is SEC governance law, GPLP structure. But once you get inside that, you can go to individual deal flow directly. So all the benefits of direct deal flow, but with a legal structure that provided the protections to investors. That exemption would allow you to function without a broker-dealer. However, the further you go afield with this type, the more likely it is that you're going to need a broker-dealer, or at least a broker-dealer sort of structured as a merchant bank to make this work. So we're actually adding that capability. It's more a compliance issue. I don't ever want a problem. And I'll put myself in another regulatory structure to be able to have that. But a radical departure for a firm that was an RIA for 20 years without any kind of transactionary business. And I always prided myself to be arm's length, and yet what my clients were telling me was, we can't get to anything differentiated. And what my sales guys are telling me is, I can't book a meeting with a big family because I don't have anything to lead to do that. And then, of course, we all have the fee compression. So I hope I answered your question, but yeah, structurally, that's how we did it. That's how we did it. And we could go without the BD, but we're going to take it on just because I think it's safer from a regulatory standpoint.
Yeah. So as we wrap things up here, I'm going to ask one final question, and that is, if each of you could recommend one thing to help advisors build a more sustainable business, what would it be?
I'll start.
Down there.
Give up your office. And what I mean by that is your office is your least productive place. When you think about office comes from the word bureau, which is bureaucracy. It's a place where nothing gets done. You go in there to hide and look at stuff and analyze stuff. You're not creating or expanding relationships when you're in there. Give up your office, force yourself to be out and interacting with your best relationships, and that'll help your business.
I'll give you another book, since I'm handing out books to read, is The E-Myth by Michael Gerber. If that's one thing to look at and follow the model of, following all the steps in the E-Myth, that has really helped me tremendously to make sure that my business is going to be sustainable. I don't have to be there for it to run. And anybody that I can bring in, just like Matt said, regarding the people that you hire, a lot of people go out, they're like, I need to hire a manager, I need to hire a COO. I've actually just hired people based off of personalities, and I can train them on that if your system is set up properly. So work on the business, not in the business, is my big piece of advice. And I've even hired a coach. So that's something too, that it's like, if you can find a good business coach, they're your COO in a way, and you can fire them at any time when they're an outside consultant, so it makes it even easier. But that has changed the business tremendously for me.
Okay. And did you actually find a good business coach?
I did. It's the CEO think tank. If anyone's in the Philadelphia area, that's the coach that I use, and she's affiliated with Vern Harnish and the Rockefeller Habit program.
Very cool. And David, your one thing?
Yeah, I love Matt's answer. That's a terrific answer. But once you get in the field, I would think about partnering with your clients. They got so much to tell you about what they need, what you should be doing, projects, opportunities. And most of us we think about serving them, we don't really think about partnering with them. And they're incredibly impactful to your business, if you frame it correctly, to tell you the story of what you need to do. And if you don't have a dialogue with them every year where you sit down and you say, okay, here's the process, tell me everything about what we're doing, what's really valuable, what's not valuable, who's contributing, who's not contributing. I think it's the most important thing you can do.
Excellent. Well, I would tell you, as a firm that does succession planning, building sustainable business is our bread and butter. But honestly, folks, it's not something that is done nearly often enough. Advisors, talk about and think about their own business plans, and it is not something that happens by default. It happens by design. It requires active engagement and management with it every single year. So I appreciate all of the commentary each of our amazing panelists was kind enough to share. I imagine probably each of you will be available, but for you, Matt, I know you got to catch a flight, but would be available to answer any questions afterwards.
Absolutely.
Okay, excellent. Thank you all. Great.
David, panelists, thank you very much. Thanks. Good job. Thank you, Matt.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.